Hello, welcome to FM with Sir Evans. In today's session, we will discuss the first competency in the syllabus of ICA Paper 2.4, Financial Management. Let's get started. Financial management refers to that aspect of management which involves planning and controlling the financial affairs of an organization to ensure that the organization can achieve its objective. Financial management is a decision-making process that is concerned with the planning, acquiring, and utilizing funds in a way that the firm's desired goals can be achieved. So when we look at financial management, we are looking at one, how much finance the business will need from day to day to operate it and also to achieve its longer-term objectives. So when we look at the operational activities of the entity, we'll be needing some day-to-day funds. And also we'll look at the sources of this finance. Where should the finance be obtained and whether it should be long-term in nature? So when we look at the sources of finance, you could either be getting it from debt or equity, where debt is acquiring it from other financial institutions and it will come as a debt to you with the obligation to settle certain interests. And with equity, we are looking at you making it you allowing certain people to subscribe and become part owners of the entity. And through that, you are going to get your finance. So you consider these two sources and also how to manage short-term cash surpluses and short-term cash deficits. So while you run the business, there could be instances of cash surplus and you have excess cash in your hands. How should you go about it? This is what financial management seeks to address. And the amount to be paid out as dividend, whether a dividend will even be relevant or irrelevant, is a question to be answered. And how to protect the organization against financial risk, such as changes in interest rate, changes in foreign exchange rates, and so on and so forth. Each type of organization has a primary objective, and this primary objective is linked with the financial objective of the entity. So for primary objective, we have one type of organization, which is a profit-making organization. So they seek to maximize the worth of the company's owners and thereby seek to make more profit. And we have state-owned organizations who are in to provide certain standard public services to the citizenry of a jurisdiction. And these do not seek to make profit, but look out to satisfy the social needs of the citizenry. And also we have charitable organizations who fulfill charitable purposes, such as standing and being an activist for people with disabilities, and so on and so forth. Okay, so decision-making are therefore strongly linked to the choice of objective. The identification of a primary objective is starting for the formulation of the strategy to achieve that objective. However, certain constraints are being faced by the entity. We have legal constraints, which means that whatever activity that the entity will engage in towards achieving those objectives, it must be legal. For the fact that you are interested in making profit doesn't mean you should engage in illegal activities. So there is a legal constraint. And also you need to consider the interest of other shareholders. So we are looking at wealth maximization. The main corporate objective is the maximization of shareholder wealth. And this is taken as maximizing the market value of the company. We can achieve this particular wealth maximization by one, maximizing profit. So for this, targets are set for profit growth. And this is quite clear and easily understood by management and investors. However, this may lead to focusing on short-term profitability and give insufficient thought to longer-term effects of their choices. And the second one is growth in earnings per share. So when the earnings of an entity grows, then there will be more profit to pay out to dividends or to reinvest into the business. So this results in shareholder wealth growth over the long term. However, this could be achieved by increase in borrowings, which raises the financial risk of the entity. So I have some ratios for measuring the achievement of financial objectives. We have the return on capital employed, the return on shareholder capital, and then earnings per share and dividend per share, and also the total shareholder return, which will all gauge how well the entity is achieving the financial objective. So return on capital employed is the profit before interest and tax divided by the share capital and reserve plus longer term debt capital and preference share capital. All of these multiplied by 100. So the profit before interest and tax, therefore, stands for that operating profit that the entity will make. Return on shareholder capital is the profit after taxation and preference dividend all over share capital and reserves, earnings per share, and then dividend per share. And we also have the total shareholder return. So financial management comes with certain decisions, and then the financial manager must provide advice. And this advice is often around 3 fundamental pillars and is supported by other forms of advice. So we'll look at the first one is the investment decision. So the entity in its bid to grow must decide whether to merge with another entity, to acquire another entity, or to go by generic growth where it reinvests its profits till it becomes that big entity that it seeks to achieve, that objective that it seeks to achieve. So some investment decisions, one, merging or acquiring. And also, you could also engage in capital expenditure projects, and that is longer term investments into its business, and working capital and trade investment. These are some of the investment decisions that the entity must make. So financing decisions, it needs to look out for a source of finance that is suitable and adequate, and also how much money even to go for to invest in the business, to use it in its working capital management. That is something that the finance manager needs to be able to make, the decision he needs to make. The level of gearing, he needs to gauge how well the entity is able to survive with or without debt. And with the increase in debt, it means the company is becoming more geared. And this comes with the obligation of satisfying the interest payment, and that may take a toll on the profitability of the entity. So it's a decision that must be made. And in minimizing the cost of capital, that's a basic policy objective, to minimize the company's cost of capital, because for a given annual return, the total value of a company is maximized when the weighted average cost of capital is minimized. Weighted average cost of capital can be changed by altering the financial gearing of the company and changing the relative amounts of debt capital. Dividend decision. So the company may prefer to retain earnings as a source of new finance as compared to issuing new shares, which comes with no issue costs or formalities required. So the shareholders will also expect some proportion of the earnings to be retained in the business. So retained earnings should be invested for growth in future profits, earnings, and dividend. Now, to find this, we have the Gordon's growth model, which measures the rate of annual growth in dividends. And the dividend policies that needs to be taken by the company. We have stock market company may not announce a dividend policy or paying or not paying dividend, but a consistent dividend policy is expected as it helps investors to make their decision. So to monitor dividend policy, we have certain ratio. I mentioned dividend per share, which is a percentage of earnings, as a percentage of earnings per share. We have to check the percentage growth or decline in annual dividend per share, and also dividend as a proportion of free cash flow to equity. So dividend decision is also one of the fundamental decisions that the finance manager must make in his work to manage the finances of the entity. So as I mentioned, these are the 3 fundamental decisions, and we have other decisions which support this. We have the risk management. This is what financial risks are faced by the entity. How should these financial risks be communicated, be monitored, be measured, and addressed? These are all parts of the other decisions that must be made. And communicating financial policy to stakeholders. We need to communicate the policies to the internal and external stakeholders to ensure that legal responsibilities are met and provide information that are necessary to satisfy the needs of the stakeholders. And financial planning and controlling. So you need to set targets, recommend internal controls that should be tax efficient measures, and also setting transfer pricing policies. All of these things are the other decisions that must be made. So you realize that all these decisions are interrelated. All three types of decisions, they are interrelated. Thus, the financial decision will affect the cost of capital. And as a consequence, the net benefit obtainable from a particular project is also going to be affected. So when the finance decision changes, it's going to affect whatever money is available to invest. And that also impacts the dividend decision because it's going to make profit available for distribution or not. And this is how interrelated these three decisions are and the other decisions that support it. So we'll now look at stakeholders. Stakeholders refers to any individual or group with an interest in the activities or performance of a company as they are impacted by the results. So we have, first of all, the shareholders who are also called equity holders and are considered as the owners of a company. In relatively small private companies, you'll find that the shareholders will double as the management. Now, management, people responsible for planning, organizing, staffing, leading, and controlling a business effort for the purpose of accomplishing a particular goal. Now, their key interest is to ensure that the business is profitable so that they can fulfill their obligation to all stakeholders. Employees, they are also stakeholders. They contribute labor and expertise to an endeavor of an employer, and they are usually hired to perform specific duties which are packaged into a job. So they constitute the workforce of the firm and are the ones who actually carry out a firm's operations. So the employees is made up of both past and present employees who are stakeholders of the entity. So they are often interested in a business's survival and growth so that the firm will be in the position to continue meeting their welfare needs, such as salary, pension payments, etc. Now, all of these form the internal stakeholders. Now we go to the external. The first we'll look at is the creditors. They are often referred to as payables, who lend to the firm. There are various resources. So it could be money, assets, services, and they also to finance it and also support the firm's operations. So creditors have priority over the owners when it comes to the settlement and or distribution. So creditors' interest in a firm is for the firm to be in a position to continually service its indebtedness to them by being profitable. Customers, these are the patrons of the firm's products. So no firm can succeed or even exist without a client base. So customers are interested in the firm's survival so that it can continue to supply them with the products at affordable and competitive terms, which involves the price, any discounts that will be awarded, and any quantity. So we have suppliers who are the major providers of goods and services to the company to help in its operation. Their interest is in the continuous existence of the entity so they can patronize their products. We have the society, and they refer to the community of persons within which a firm operates. They form part of the environment of a firm. The firm's obligation to them is not to cause harm to society, but to contribute to societal development and welfare. Other stakeholders, which you can see, are the government, who are interested in the firm being law-abiding and to also honor its tax obligations and be socially responsible. They have business contact groups such as the banks, insurers, and lawyers. So all of these also form the external stakeholders. However, with these numerous stakeholders, they have different interests in a company, and these different interests may be incompatible. Hence, it leads to conflict. So to be able to resolve this conflict, you need to sometimes compromise and satisfy all partially, which is the first option, or you are going to satisfy the most powerful stakeholders' interest first, thereby leaving the others for future. So some of the conflict between stakeholders, we have one, directors versus lenders. So the directors might wish raising more debt capital since it's going to be cheaper than equity finance. But the existing lenders might believe that the company should not borrow anymore without first increasing its equity capital. The terms of the loan agreement with these lenders may also include a specification that the company must not allow its debt level to exceed a specified maximum amount. So these are some conflicts that may come up. And also it could be government and the management. While government is seeking to raise more revenue through increasing the tax, the management will also be looking out for ways which are efficient so that they will be able to avoid certain taxes by organizing their operations in a way to benefit from any tax tax arrangements that are available. So we have shareholders versus employees. Whereas shareholders will be interested in maximizing their returns, employees will also be looking out for high wages and high salaries to be paid to them. And we can see this by the numerous demonstrations that sometimes certain group of workers go and then they do it, demanding the increase in salaries. Now, management versus activists. So whereas management will be looking out for maximizing short-term profits, activists for environmental protection would also be pushing that the management should put measures in place to invest in keeping the environment in the way in which they met it before their operation. So these are certain conflicts that come up between stakeholders, both internal and external. However, the most significant conflict of interest is between the stakeholders whose shares are traded on the stock exchange and the board of directors. So this perceived conflict of interest is fundamental to the agency theory and the concepts of good corporate governance that have developed from agency theory. So now we go to agency theory. So it was developed by Jensen and Macklin with the idea that where owners appoint the managers to manage the company on their behalf, they also give them the ability to make certain decisions, which comes along with the authority to make such decisions. But then you would find that often managers who have this particular authority given to them from the shareholders may be seeking to satisfy a personal interest over that of their owners or the shareholders. So it leads to what we call the agency conflict. So they are differences in the interests of companies, owners, and managers. So the first one is moral hazard. So a manager will have the interest in receiving benefit from his or her position as a manager, such as a company car using airplane sponsored by the firm, etc. The incentive to obtain this benefit is higher since he's not the owner. And also effort level, managers will work less hard than they would if they were the owners of the company. So the effect is that there's going to be lower profit and a lower share price. Earnings retention. So the remuneration is related to the size of the company. Hence, managers will want to grow the firm to make their remuneration larger instead of shareholder wealth maximization. Risk aversion. Managers will be interested in the stability of the company so they can protect their job and future income. Hence, they are reluctant to invest in higher risk projects. And time horizon, managers will be interested in the short term, while shareholders will be longer term focused. But then there are some agency costs. So these are the costs that the shareholders will incur when professional managers run their company. It only exists when the owners and the managers are not the same. So we have the monitoring costs, which are involved in monitoring the actions and performance of management to try to ensure that management are acting in their best interest. An example is if you are presenting an annual report with audit accounts to the owners. So this audit cost that is incurred is a monitoring cost. Unsatisfactory decisions. These are the costs to shareholders when the managers take decisions that are not in the best interest of the shareholders, but are in the interest of the managers themselves. So, for example, the managers will be acquiring a new subsidiary at higher cost so that they can personally gain from managing these larger companies. Now we have bounding costs, which are incurred to provide incentive to managers to act in the best interest of the shareholders. So because managers and shareholders are different, there are certain conflicts that arise, and to manage this conflict, we have certain costs that are incurred. So how then do we reduce the agency problem? So one, we have remuneration package, where it will be made up of the basic salary, a performance incentive, and also longer term performance incentive. So usually this could be share awards or share option, where share awards, the company will purchase a quantity of its own shares and awards these to the executive directors and other senior managers on the condition that certain long-term financial targets need to be achieved. And this could be over a 3-year period. We have share option, where the company will give the managers the right to purchase new shares in the company on or after a specified date in the future, often from 3 years after the options have been awarded. So you realize that it changes the focus of the managers, so they are looking out to make the business more profitable to increase its shares because they are going to benefit from the good performing company that they are managing. So the second one is independent non-executive directors. So they have no executive role in the company and are not full-time employees. So when they find themselves on the board of directors, they are able to act in the best interest of their shareholders since they are not into the management of the entity. And also these independent non-executive directors will also take decisions where there is a conflict of interest between the directors and the best company's interest. Thereby, they bring about diverse decision-making on board. So some of their decisions will involve the remuneration package for the executive directors and other senior managers. So the various measures for reducing the agency problem are often contained in the Code of Corporate Governance. So corporate governance, it describes the way in which the companies are directed and controlled. So the shareholders are those who employ the directors to manage the company for them. And as I mentioned earlier, there is a conflict between the interests of these shareholders and the interests of the directors. So the sources of corporate governance, I would say, for example, in Ghana, we have the Companies Act, which sets out an organizational framework for both public and private companies, as well as special provisions for public company. And we also have the listing rules of the Ghana Stock Exchange, which is also known as the listing rules, and they specify the disclosures to be made by listed entities with view to ensure that securities are fairly priced on an ongoing basis. So this forms how the management of this entity should be. So that's the corporate governance. So some of the issues are, one, the role and responsibility of the board of directors and the composition and balance of the board of directors. So when it comes to forming the board of directors, you need to specify what roles and responsibilities they need to go by, and also even how many people, and then gender balance on that particular board. And even also you'll be looking at involving diverse people with specializations in certain areas to help the business make the right decision. And also we have financial reporting, narrative reporting, and auditing, the director's remuneration. All of these, there are certain issues in the corporate governance that addresses them. And we have risk management and internal control, the shareholder rights, and also disclosures that must be made. Corporate social responsibility, CSR. This refers to the responsibilities that the company has towards the society that it finds itself. When we talked about the stakeholders, we mentioned external stakeholders. And among that, we had the business groups, contact groups, the society. So some key areas of responsibility, we have the general responsibility, which are a key part of the board's duties, which need to be completed in order to succeed in the industry and regulatory requirements imposed on them. So example of general responsibility, we have the payment of tax being cost efficient. Now, beyond general responsibility, so these are duties that go beyond the general responsibilities, such as being committed to a net zero emissions and the protection of the environment. So some principles of corporate social responsibility, they operate in an ethical way with integrity. Employees need to be treated fairly and with respect. And there should be a demonstration of respect for the basic human rights. Be a responsible citizen in its community and do what the entity can to sustain the environment. So these are some principles of corporate social responsibility, where if a company says it is socially responsible, then we should find it meeting some of these principles. So the concept of CSR is often consistent with the expectations of the stakeholders of the company, and it informs how it should be governed. However, and this also affects the reputation of the entity. However, some companies may consider this as a way of marketing their product instead of fighting for a genuine cause. So we'll look at the economic environment of the entity. So we have macroeconomics, which looks at the economics at the national or international level. Micro, which considers individual firms and markets. Economic growth, or GDP, which is measured by rate of growth in economic activity each year within a country. Fiscal policy, which considers the government spending, taxation, and borrowing. monetary policy, which looks at the monetary issues such as the inflation rate, the interest rate, exchange rate of the company. So these are all constituents of the economic environment where the business operates. So we'll look at the functions of certain specialized institutions. We have the Central Bank of Ghana. So I'll be picking some of them randomly and explain. So we have the formulation and implementation of the monetary policy. So the Bank of Ghana keeps a tab on the interest rate, the exchange rate, and also the inflation rate, and make sure that measures are put in place so that they are kept at the best rates possible. And also they need to promote by monetary measure the stabilization of the value of the currency. So they need to ensure that a cedi today is going to worth more tomorrow instead of depreciating against other currencies. And also they will institute measures which are likely to have a favorable effect on the balance of payments. And they are also going to issue and redeem the currency notes and coins. So currency notes which are fading out of the which are fading would also be replaced by the central bank. They also act as the banker and financial advisor to the government. We have the Security and Exchange Commission, who advise the minister on matters related to securities industry. They also maintain surveillance over the activities in the securities to ensure there is an orderly, fair, and equitable dealings in the security. They also formulate policies, principles for the guidance of the industry. So the Security and Exchange Commission will ensure that there is a fair ground for anyone who wants to deal on the stock exchange. We have the National Pensions Regulatory Authority, who register occupational pension scheme. They provide register provident funds and also personal pension scheme. They issue guidelines for the investments of these pension funds. They also approve, regulate, and monitor trustees and pension fund managers and the other custodians who deal with the pension as the authority may determine. We have the National Insurance Commission, who license insurers and insurance intermediaries who transact insurance business in Ghana. They also encourage the development of and compliance with the industry's code of conduct, and also approve the rate of insurance premiums and commissions in respect of any class of insurance. So that's what the National Insurance Commission performs. So any player in the insurance industry must ensure that it's in compliance with the various guidelines of the National Insurance Commission. So we'll look at some international financial institutions. We have the World Bank, which consists mainly of two institutions. We have the International Bank for Reconstruction and Development, who provide financial assistance in the form of loans to middle-income countries and also poor countries who are credit-worthy. And these are funded by monies raised through the issue of bonds by the World Bank. And the International Development Association, which provides assistance to poorer countries in the form of interest-free loans and grants. And they are repayable over 35 to 40 years with grace period of 10 years averagely. We have the World Trade Organization, who negotiate the reduction or elimination of trade barriers between countries, who also monitor and review trade policies of the members in the WTO, and also ensure transparency of regional and bilateral trade agreements that are entered between parties. And also, they also work to build the capacity of developing countries in international trade matters. So International Monetary Fund, IMF, they also provide international monetary cooperation. They promote exchange rate stability, and they provide temporary financial assistance to countries who need them. So I would like to thank you very much for staying with me to the end. Kindly follow the link below to join the Telegram channel that's created for the paper, where you can have access to the slides and other relevant materials to aid your preparation. You also get to interact with other students preparing for the paper. I would like to thank you once again, and I'll see you in the next session.